Morgan Stanley's recent note to investors appears to be suggesting that the Chinese government will target Tesla next in a crackdown on cybersecurity data protection. Hello, my friends, and welcome to the channel. Now, if you've been wondering what is up with my funky looking arm here, well, I was riding my BMX bike with my son at the BMX track, and I tried to do a dad jump and had a big stack. It also happened to come after around about 2 hours of sleep one night and filming YouTube videos for you guys to watch. Hope you enjoy them. Well, Morgan Stanley has just reported that China's Didi crackdown could have implications for Tesla, and I think they're right. I agree. I own Tesla stock, and in this case, I often don't agree with what Morgan Stanley say. I think they're a little bit too conservative about their Tesla predictions, although they're on the right track compared to how they used to be, which was insane. They used to get Tesla predictions wrong all the time. They've done much, much better over the last 12 months. And in this case, I actually think they're right on the money. You're probably thinking, well, who the heck is Didi? Didi is a Chinese vehicle for hire company headquartered in Beijing, China, with over 550 million users and tens of millions of drivers. It's a little bit like Uber. The company provides app-based transportation services, including taxi hailing, private car hailing, social ride sharing, and bike sharing, on-demand delivery services, and automobile services, including sales, leasing, financing, maintenance, fleet operation, electric vehicle charging, and co-development of vehicles with automakers. The company is a subsidiary of Yaoyu Kuaichi Inc. And very interestingly, it actually acquired Uber in China because Uber was losing over $1 billion per year in the country. So in the beginning of 2016, Uber China, which started its Chinese operations in 2015, had become a major competitor to Didi. Uber's then CEO, Travis Kalanick, claimed the company was losing over US $1 billion annually in China, which was obviously unsustainable for Uber. In June 2016, Didi closed a US $4.5 billion fundraising round with investors including Apple, China Life Insurance Company, and a financial affiliate of Alibaba Group Holding Limited. As part of the round, Didi secured a $2.5 billion syndicated loan arranged by China Merchants Bank Co. This equity share fundraising round is one of the world's largest ever by any private company, surpassing the previous record, which was also set by Didi. So then on the 1st of August 2016, Didi announced that it would acquire Uber China in an acquisition valuing Uber China at US $35 billion. As part of the deal, Uber acquired 5.9% of the combined Chinese company with preferred equity interest, which at the time equated to a 17.7% economic interest in Didi. The transaction also provided Didi with a minority equity interest in Uber. In April 2019, Uber released a public version of its S1 filing ahead of its planned initial public offering. As part of the filing, Uber revealed that at the time of filing, the company owned a 15% stake in Didi. Uber's stake in the company was diluted from 17.7% in 2016 to the 2019 stake, as a result of new investments from additional investors since 2016. Now, overnight, while I filmed this video, the ride-hailing company actually fell 4.6% in New York, trading to close at $11 US.91. The American Depository shares slumped 20% in Tuesday's session and now trade 15% lower than the $14 they were sold at in the IPO. Now, Didi's offering was the second largest US listing for a Chinese firm on record. The company has lost over $17 billion of market value so far this week, including about $15 billion on Tuesday alone. The Chinese government has made it very clear that they act in what they believe to be their own best interests, said Steve Sosnick, chief strategist at Interactive Brokers. This doesn't rule out the idea that one could or should invest in China. It just changes the risk premium that is required. Now, China's regulators' recent cybersecurity probe into ride-hailing company Didi could have implications for electric vehicle maker Tesla, Morgan Stanley just said. As regulators in China crack down on data protection, the bank said the growing scrutiny could affect how foreign companies operating there store data needed for autonomous driving. Now remember, of course, Tesla vehicles all collect data all around the world, wherever their vehicles are on the roads. So all over Europe, Australia, Southeast Asia, China, United States, Canada, and many other countries. Tesla's vehicles collect data on a daily basis in order to feed their neural net so that they can train their autonomous driving software. Now, Adam Jonas said in a note released yesterday, the regulations around autonomous driving in China will get stricter over time and may present some increasing challenges to foreign automakers in the years ahead. After he said that, made that comment, Tesla shares declined by 1.8%. Now, I don't know if those two things were related. I would say they probably weren't. But China is a key market for the electric vehicle maker. And Chinese sales made up about 30% of Tesla's revenue in the first quarter of 2021, according to the company's latest quarterly report. Now, that's after Tesla's sales in China doubled in 2020 to make up about a fifth of the company's total revenue that year. And I think the number of vehicles that Tesla manufacture in China will significantly increase over the next 1, 2, 3 years, partly due to lower cost of manufacturing in China, partly due to the government's support of EVs, partly due to the lower cost of sourcing parts in China, partly due to the fact that there are 1.37 billion people in China, all who want EVs. People in China don't see EVs as uncool. They don't see them as not fast. In fact, they see them as the future. People in China see EVs as what they are. However, Tesla's brand reputation has faced challenges in the country, largely due to ridiculous clickbait antics by just a few people. Now, most recently in June, China's Vehicle Safety Authority announced a voluntary recall by a software update of around about 285,000 Tesla vehicles due to reported issues with driver assistance systems. However, remember, no one had to do anything. They just had to make sure their car was connected to the internet for this fix to happen. Wouldn't that be a dream for every other car manufacturer to have that option of, rather than recalling the vehicles, making everyone bring the car back into the dealership and then having to have the car for a few hours or a day or however long it took to upgrade the car, they could just update the car overnight. That's an awesome feature. Now, despite growing pressure in China, Morgan Stanley maintains a bullish view on Tesla. The firm reiterated its overweight rating on the stock and a price target of $900 this year, implying upside of more than 36% from the stock's Tuesday close. Jonas said he is optimistic on Tesla's ability to expand its production and commercial footprint outside of China. The analyst also said the company's business in the country could be a separate Tesla China legal entity in the long term. I think that's pretty unlikely. I think he's going off on a limb there. Bit of a strange thing to say. However, we should note, the only person in the world, the only analyst that correctly got Tesla's stock price correctly predicted Tesla's stock price a couple of years into the future was Cathie Wood. And she is now predicting that Tesla's stock price will be around about $5,000 by 2025. That means there's a long way for Tesla stock to go by 2025. Of course, her prediction does include Tesla vehicles by that date having the ability to autonomously drive themselves. And considering that date is 4 years into the future, considering the work Tesla is putting in now into automation, into building their supercomputer that they have, one of the world's fastest computers, and considering how much the company is focusing on it, I think there's a good chance Tesla's automation software will be in operation by 2025. But who knows? I could be wrong on that. Let me know what your thoughts are in the comments below. Do you think Tesla will have finally solved the full self-driving issue by 2025? Or will that take even longer than 4 years? Thanks for watching the video. I'll see you on the next one. Bye-bye.